Well, welcome. Happy Friday on the end of February. We are really looking forward to a great session with Katherine from the Federal Reserve Bank of Atlanta. My screen is a little silly. Let's try this again. There we go. We would think we figured this out after a couple of years, but just wanted to thank our anchor investors. You'll see everyone here on our screen, but these anchor investors are so important to what we do here at Max and really able to support our work. So just thank you if you see these organizations, please thank them for all of their investment in Max and everything they do to support workforce development in Metro Atlanta. So again, I'm Daniela Perry. I'm the Vice President of the Georgia Chamber Foundation, and I serve on the Board of Directors for Max. We are so excited to have Katherine with us today to present on some recent research that the Federal Reserve Bank of Atlanta has conducted around CDFIs. So please, make sure as Katherine's presenting to be thinking of questions. We've got something to get started too, but certainly, if you've got questions, feel free to put them in the chat as we're going along, and we'll get to those. But Katherine, I'd love to go ahead and turn it over to you to start our presentation this morning.
Great, thank you so much. Let me share my screen. Can you all see the slides?
Yep, it looks great.
Perfect. Thank you so much, Danielle, for the warm welcome. And thanks to Max for having me today. I'm really excited to share the research with this group. And I was scrolling through our participants today and really excited to see some familiar faces here. I have to say, I think that all of our Max members on the call and likely others will already know the punchline, and that's that partnerships are important. And I'm excited to show you guys how partnerships really scaled up some workforce financing solutions through CDFIs and workforce development organizations. Before I get any further, I wanted to remember to give our disclaimer that the views here today are my own and do not necessarily represent the views of the Federal Reserve Bank of Atlanta or the Federal Reserve System. Now that you know that, what are we going to talk about? So I want to give a little bit of stage setting on the state of workforce financing in the United States and why innovations are important as we move forward. And then I'll give just a brief background on the CDFI industry, who and what CDFIs are and how they currently participate in our sector. Then the bulk of the conversation will be about 3 different case studies. One was with a local credit union who offered students a loan alternative through small dollar loan products to individual job seekers who need credentials. The second is a larger project in using a new market tax credit transaction between a community college and a national CDFI. And then finally, a business expansion loan that had many different CDFIs as partners. And I'm excited to share that it was First Steps expansion into Philadelphia, which you saw is one of Max's anchor investors. And then, as Danielle mentioned, there's time for questions at the end. But if you have clarifying questions throughout, I will do my best to keep an eye on the chat and happy to answer those as we go along. All right, let's jump in. These 2 charts show us how the US stacks up against peer countries when it comes to public labor market spending. And here it's displayed as a % of GDP. So on the left, you can see that in 2018, the United States spent less than any other country, industrialized country, on labor markets as a % of GDP. But on the right, you can see that that might not always be the case because our spending is highly variable year by year. If we were in a room, I would ask people to raise their hands and tell me what they thought these spikes were in the late 80s, early 90s, early 2000s, and 2007 to 2009. But since we're not, I won't make you put it in the chat. These are recessions. So you can tell that our workforce spending is very reactive on the public side to help people during a recovery. No doubt the pandemic stimulus will cause the same spike in recent years. So here's a quick view of some of the key programs that public funding supports. The current method of funding is highly decentralized, but the programs are designed to be accessible to meet the needs of workers and employers, but with inconsistent funding, they might not meet the full demand of the economy, and there might be other challenges with workforce organizations trying to implement financing solutions. Of course, the public funding is not the only way that workforce development is funded. So employers play a key role in helping workers upskill and reskill to meet the needs of their jobs. As you can see, though, most of this funding goes to workers who are highly educated, having a bachelor's degree or even higher. Very often, those programs are structured as an employee benefit that might reimburse tuition for a graduate program or provide funding for a certification such as a PMP or a CPA or other relevant certifications in your sector. Even with the programs that are designed as reimbursement benefits through employers, those can have access challenges because some workers might not have the financial stability or financial freedom to pay for those programs up front. And as you can see, as you move through education levels, these programs become less available or less accessible due to other barriers. That may have been a refresher for many of you, but I wanted to make sure that we were all on the same understanding of where workforce funding was and how we can make improvements and why improvements are needed. So let's move on to CDFIs. CDFI stands for Community Development Financial Institution, and they are at the heart financial institutions that are interested not just in making a profit, but also in creating an impact for their economy. So CDFIs have the goal of expanding economic opportunity into low-income communities through financial products, and they're willing to accept higher risk than their traditional financing partners. Because their clientele is generally low-income communities and people who are underserved by traditional banks or financing organizations, it overlaps very often with the same clients that we in workforce development seek to serve. You can see here that many CDFIs are loan funds, and about half of them are, in layman's terms, a bank, a credit union, a bank, a holding company. And CDFIs are, while they do provide loan products and lending, they're also connected to the financial system and the regulatory system to be able to provide technical assistance both to businesses and to individuals. Many CDFIs are already working in workforce development in some capacity. And there was a survey in 2019 that captured two main categories. The first category was on increasing the supply of quality jobs, which was done through loans or technical assistance to start and grow small businesses, which subsequently increase employment opportunities in a local labor market. Or another way that was often cited was to work through training or job placement services. There were roughly 557 respondents to the survey, and 57% of them identify workforce development as something that they already participate in some way. I want to pause here and check the chat. Noticing that Jen mentions that even at the height of our spending in 2010, our public spending, we're still at just over 1%, about 1.25% of our GDP compared to other nations can still be very low. All right, let's look at our case studies. A little bit of background that these case studies were collected through interviews and conversations with the CDFIs, who were often joined by other partners from the project. The first case study shows how existing products can be used to finance education and training for students and for learners. The partners here were Freedom First Credit Union and Commercial Driver Services Incorporated, which are both located in Southwest Virginia. Freedom First was one of those CDFIs who said, hey, we're doing workforce development loans. They realized that through their personal loan product, they were helping students pay for credentials that were valued in the local labor market. So the goal here was to be able to scale that program to provide accessible and affordable capital to more workers and students. So as I mentioned, Freedom First said, we're doing this for students through our personal unsecured loan. But they noticed that there were certain needs of students who were credentialing that were different from other personal loans. So they decided to rebrand part of their personal loan as a workforce development loan and create a couple of unique qualities that made it a better fit for workforce development. So first, they connected with Commercial Driver Services, which is a local training provider that provides certifications of commercial driver's license and job placement into truck driving employment. So CDS worked with Freedom First to refer their students back to the credit union as they were deciding on the best way to fund their employment. And Freedom First worked with the students through custom underwriting, including their credit score, but also things like bill repayment, employer references, and other factors to secure approval for the loan. The terms of the loan were generally up to 36 months and $5,000. $5,000 was decided on because of the amount of tuition that it costs to complete CDS is up to $4,500, but often less than that if the student is in state. The average interest rate for the loan from Freedom First to CDS students was between 10 to 12%. So if you look at the table we have here, you can see that 11% is sort of our average interest rate, and 18% is the highest interest rate that students would have from Freedom First for this program. And I've compared it to the prior third-party lender that CDS was connected with, which was offering a 25% interest rate, regardless of credit history. You can see off the bat that the savings for students was between $3,000 or $4,000 all the way up to $23,000 if they had the average rate, and even greater for students who had a below average rate. One of the other unique features that changed when Freedom First connected with CDS was to disperse the loans directly to the training provider, so that they were ensuring that the funds were being used for their intended purpose. As a part of that agreement, CDS also agreed that if a student was unable to complete training or decided that the credential was not for them, CDS would reimburse the Freedom First directly rather than back to the student. So the student didn't get strapped with debt that was intended to be used for training that they weren't able to complete and have the benefits of being employed through that credential. And then finally, one of the ways that they worked with students in CDS was to defer the loan payment for up to 60 days, as the training program is roughly 4 weeks long. And this gives the students time to secure their employment and maintain a few paychecks before they have to start making payments on the loan. So a bit of the social impact of this was that obviously, as we saw prior, the third-party lender was way more expensive for students, and they are saving a lot of money through the Freedom First loan. But they also are able to develop a relationship with a credit union at a time when it might be hard for them to access capital from traditional banks or other organizations within the community, which not only provides a long-lasting account and access to credit, but Freedom First also offers counseling services for homeownership, auto loans, credit improvement. And Freedom First mentioned that one of the most important things for their clients is the auto loans, because it's a very rural area in Virginia. And transportation can be a major problem for workers. Two things that CDS and Freedom First worked together to do was create this financial education curriculum, which they call On the Road Finance, which is available to all of CDS's students to learn how to manage their funds when they're transitioning into this new lifestyle of truck driving, where they might have long hours or long days on the road. And then one of the challenges that Freedom First and CDS faced at the beginning of this program was that they had a higher than expected delinquency rate. After talking to students and explaining why Freedom First is different from other traditional financing organizations, they realized that connection and that partnership really made a difference to students. So they created a video with CDS that explained the partnership, and that as they're repaying their loans, as the borrowers are repaying their loans, they're also providing opportunities for more students to have this credential in the future. Since they've launched this loan with CDS, they've also created relationships with healthcare and welding organizations to provide loans for those students as well. Freedom First really credits the relationship that they had with the workforce development organizations for the success of the loan product over time. The next case study that we'll talk about is the New Market Tax Credit real estate, which is used to finance infrastructure for workforce development. So very different from the last one. One of the reasons we chose these three case studies and looked at these three was that they provided very different styles of financing, and we thought that we could learn a lot from how we can put these into scale these into other markets as well. So the major organizations for this project were Ivy Tech Community College and LISC Indianapolis. Ivy Tech is located in the mid-north neighborhood of Indianapolis, and they were seeking to develop a historic building in a majority Black neighborhood and transform it into a culinary arts facility to support training within a community. As I already mentioned, transportation is an issue in rural areas, but it can also be an issue in urban areas, as we all know here in Atlanta. So the goal was to take the training to the students. So here is a picture of the building, fully refurbished after the project has been complete. Ivy Tech wanted to acquire and renovate the historic Stouffer Hotel, which was in a neighborhood that was historically challenged with high unemployment rates. The building was historic though, so Ivy Tech worked with local community leaders to maintain the culture of the building and respect its history. The new building, like I said, would create training facilities for culinary arts, but also provide other workforce development, classrooms, and administrative offices for the college. A little bit of background on New Market Tax Credits, as they're highly complex and there were many different organizations involved in this deal because of their complexity. New Market Tax Credits were launched in 2000 as a way to incentivize economic development in underserved low-income communities that are perceived to have higher risk. The goal was to bring private capital into these communities by providing a partially guaranteed rate of return through the tax credit that was available regardless of if the borrower paid back the loan. So this is the details of the new market tax credit deal and transaction for Ivy Tech, but to tell you a little bit about how this project came about for Ivy Tech, it was led by the desire of the community college to acquire and renovate this hotel into a training facility, but they needed to secure capital. Lilly Endowment, which is a local donor to Ivy Tech and other workforce development, community development projects in the Indianapolis region, donated $23.5 million, which would eventually serve as a major part of the capital used for the project. $23.5 million is a lot of money, but it was not enough for both the acquisition and the renovation to start. So Lilly Endowment had worked with LISC Indianapolis in the past and was able to introduce LISC Indianapolis and Ivy Tech Community College. And LISC realized that this project was aligned with their wider strategy to engage universities and colleges as anchor institutions for workforce development and community development in low and moderate income communities. Was excited to join the project and provide technical expertise and connections to private capital to move through the transaction. So the Lilly Endowment Company donated money to the Ivy Tech Community College for this project and also connected them with LISC Indianapolis. And then LISC was able to connect to Chase Community Equity, who donated roughly $10 million, or who lent roughly $10 million to the project. LISC also provided connections to attorneys who specialize in new market tax credit transactions. As if anyone has worked with new market tax credit, one of the first pieces of advice is to hire an attorney. So through this lending and the donation provided through the Lilly Endowment, that investment fund moved through community development entities, which is a specific new market tax credit structure that grants loans to qualified businesses, in this case, Ivy Tech, to complete the acquisition and renovation of the project. Now the exciting stuff. The building now houses 7 different culinary labs, an upscale restaurant and bar, a cafe, full catering operations for the conference center, and some more classrooms for their corporate college. So you can see here some pictures of student and teachers working in the labs and at catering events. The restaurant is one that you're able to visit, and students work within the restaurant so that they can have real experience in a kitchen providing service to customers and bring that into their employment opportunity. Because new market tax credits are so complex, their scale is much wider than the sort of $5,000 loan that we saw in the last one. So in these cases, underwriters generally focus on deals that are upwards of $25 million. New market tax credits are federally funded through the Department of Treasury. In 2021, there was a $5 billion allocation to the program. All right, so our final case study that we're going to discuss today is about business expansion loans, because financing is not just a struggle for workers, but it's also a challenge for nonprofit providers of workforce training and services. So let's review this example. This project had many different players, as we'll see in a few slides, but the major players were on the financing side was a nonprofit finance fund, and the workforce organization was First Step Staffing, which was founded here in Atlanta. And First Step was looking to expand their operations into the new market of Philadelphia and needed a business loan to complete the transaction. So first step was planning to acquire On-Time Staffing, which is a local Philadelphia staffing firm, rather than starting up their own new branch. And because of this, they needed capital to acquire and have working capital to stand up services in the new market. There was a group of 4 CDFIs that provided working capital for the project, and others who were able to provide acquisition capital. The underwriting for this was unique because the financial records of On-Time Staffing was used for projected cash flows for the First Step Philadelphia branch, but the track record of success of the Atlanta office and their management team was also taken into consideration. So here's a look at what the capital stack looked like. So as you see, there are 4 different CDFIs that serve as senior debt in this project, and many other organizations that played a role in making this acquisition possible. I'll skip to the next slide to talk a little bit about how Reinvestment Fund, which is a Philadelphia-based CDFI that was connected to First Step through Nonprofit Finance Fund, they were able to connect First Step to local leaders in government and philanthropy that provided grants that reduced the debt load and made this project less expensive for First Step. And I mentioned that they used On-Time Staffing finances at the start of this project, and then they also used the management record of First Step in Atlanta, but what they did not use for underwriting this loan was the financial records of First Step in Atlanta, which really made this a different sort of project for many of the organizations. So First Step measures its performance by not just the number of people that they employ, but the number of workers that they employ who are experiencing homelessness, were recently incarcerated, veterans, the length of their employment, and the wages that they make. In the first year of First Step Philadelphia's operations, they employed 2,600 workers, half of which were recently experiencing homelessness, and 500 of which were formerly incarcerated. Since the expansion into the Philadelphia market, First Step has expanded into other markets as well. They've also added another branch in Philadelphia, and the Philadelphia market pays roughly $17 million in wages, which is the largest market for 2020 behind LA. So here are a couple of key takeaways, but as I mentioned at the start, what I want you to remember is that CDFIs have financial products, but they also have connections into financial markets that can be very valuable to workforce development organizations as they're looking to finance different types of projects in different ways. The partnerships and the collaborations between the organizations made each of these projects successful, which is something that I know we value in NACS, to say that this is a whole system. We all work on these projects together, and that was this. These are 3 examples of how CDFIs and workforce organizations can really expand their reach to workers who need it. Thank you. I'd love to take questions now.
Catherine, thank you so much. That was a lot of information, and we are so excited to continue to move through. So again, I think Joy put a note too in the chat, but feel free to add questions, things that are popping up. I know we have one in the chat. They're in the middle of a mixed use development project with new market tax credit commitments. Any recommendations on identifying philanthropic support, or maybe models that you've seen be effective in different places in terms of those partnerships, or who could maybe be likely resources for folks to connect with?
Yeah, so I want to lean on, as you're working with these really complex financing solutions, that the partners that you've brought to the table, they have a network. And in each of these circumstances, they were able to lean on the network of the other groups within the project to bring more members to the table. I'm sure that you have worked together to find this, but taking a step back and saying, where do we have connections through these different organizations that we can leverage and find interest in our specific project? And I commend you for new market tax credits, because I know that they are very complicated and have a lot of different steps. So finding all of the right pieces can be a challenge.
Absolutely. So again, please feel free to keep adding your questions to the chat or the Q&A. And then, I know, Katherine, you mentioned, takeaways from some of the examples that you shared in those case studies, but, kind of just digging a little bit deeper, what stood out as kind of the biggest opportunities for future projects, and where do some barriers maybe continue to exist that kind of limit the ability of, how to build these partnerships, but kind of what takeaways do you have in terms of opportunities and challenges as well?
Yeah, so I do think that one of the challenges is building the partnerships. With the first example with Freedom First and CDS, they said that finding those relationships with training providers is one of the hardest parts about standing up a product like this and scaling it. I think that from both sides, we also learned through this that learning how to market your projects can be really important for these relationships to start and then to blossom. So being able to talk about the projects that you have upcoming and find people who are also interested is really important. So for workforce development organizations, specifically training organizations, finding ways to talk about the products that you offer and who you serve is really important for making those connections. And without the first sort of view of what CDS did, Freedom First would not have been able to connect with them. So getting out there and talking about your product as much and as often as possible, I think, is a great first step to starting these relationships.
Absolutely. And I think that was a great example too of something that there was an existing product, but they still need to kind of make some adjustments to figure out exactly how this could work best, and then to bolster the partnerships to really make it as successful as it needed to be. It was something that was there, but they still had to make adjustments to really fulfill its potential.
Right.
Yeah. We got another question in the chat from Denise. They're working to develop an employer-assisted housing program in the Buckhead community. Are you aware of any CDFIs who have played a role in this type of program? And are there other examples, maybe in the Metro Atlanta area or other areas that y'all work in, that could be models or kind of serve as examples?
Yeah, so there are a handful of CDFIs that are based in Atlanta that do focus on housing, and I'm happy to follow up with names of those organizations. But I also want to say, if you're looking for CDFIs, if you're like, I don't even know how to get in touch with these, CDFIs it's a certified list through the Department of Treasury. So if you want to find CDFIs in your community, not just in Atlanta, you can go to the Department of Treasury's website for CDFIs and look at the list, which breaks it down by state and city. Georgia has 27 CDFIs that are based in our state, and there are many others that are national. Nonprofit Finance Fund is founded in New York, but they are a CDFI that works across the country as well. So I think that answered your question, Denise. Thank you for that.
Yeah, and absolutely. We'll certainly be sharing, opportunities to follow up and things like that and get this information. I know there have been some questions in the chat about, we'll have the recording of this as well. So if you want to refer back and refresh your memory, you can certainly do that. And kind of just, building off of that, Katherine, I know the examples that you showed were all super different in terms of how you can think about working with these different projects from infrastructure and thinking about loans and things like that. But are there certain models that you think would be really effective here, kind of from y'all's research, you see as being, ripe for opportunities to continue to grow in the workforce development space, kind of on the unique factors we've got going on in Atlanta? I think that's the cool thing that I think y'all's research showed was just how versatile this can be. But I was wondering if y'all were, just had a really great
Yeah.
idea or want someone to implement.
Yeah, absolutely. So I think that with the growth that's going on in Atlanta over the last decade and continues to expand, I'm really excited by new market tax credit opportunities. And specifically, I want to highlight that community members were a part of that process within the Mid-North region and the Ivy Tech project. And I think that being able to work with these large funding projects to provide services within neighborhoods is incredibly important. I know that MARTA can take you lots of places, but it can't take you everywhere. So really creating opportunities for workforce organizations to be located within the neighborhoods that their services are most needed and in highest demand is a great place to start. We also have many credit unions within the city who provide services like Freedom First. So being able to figure out and understand how we can make those connections, I think, is a great step for Atlanta to take to be able to provide services to more students and learners.
Yeah.
And then I think more broadly
No, go ahead.
These examples are meant to inspire creativity and action. So for you thinking about, for people providing workforce solutions, what's your need to raise capital for? And have you considered CDFIs as a way to lower your cost, your financing cost? And what would your funding be able to do if you were able to lower the debt amount and lower the amount of interest that you have to pay over the years on your projects? So I hope that people are inspired that this type of funding is possible, and there are groups who are excited and willing to do it.
Yeah, I think that's the cool part too about what y'all did, is that it is something that it can be so versatile, which gives everyone here lots of creativity and opportunity. But I think CDFIs is one of those things that maybe folks aren't quite as familiar with. And I was curious if you could kind of, I know you mentioned and shared some bit about CDFIs, but just share a little bit more about the strengths of CDFIs and maybe what misnomers exist that might limit their utilization, and just kind of give us a little bit more information about how we can start to really think creatively about this tool and how it could be utilized.
Yeah, absolutely. I think that one of the misnomers about CDFIs is that they are essentially traditional financial institutions. But in reality, they are so mission aligned to the work that other nonprofits and workforce development organizations are doing day to day. So being able to understand and see that there's that opportunity and know that, some CDFIs I would call as sneaky CDFIs, right? Like credit unions, you might think of, oh, that's just a bank that I go to and I have my account with. And you might not know that they offer services and loan products to nonprofits to be able to help this expansion of the services that we all provide. And one of the strengths that I want to say is that CDFIs not only offer capital, but they're also plugged into the larger financial sector and can provide those partnerships both to philanthropic, to grants, and to other types of funding as well that have lasting impacts on a community. So the technical assistance that they can provide and the connection that they can provide to the financial sector, I think is going to be really valuable for organizations as they're trying to scale up their programs.
Yeah, I think that's so helpful. And I love the sneaky CDFIs. I think that's helpful, especially as we are trying to think creatively and who could be good partners. Got another question from Ladarius. Venture funds make up a small slice of the CDFI community. Are there special barriers to entry for VC funds?
That is a great question, Ladarius, and I don't have an answer right now about why it's such a small amount, other than the types of institution and groups that make up venture funds have sort of a different goals with how they want to see their capital working, and the way that they accept risks.
Thank you. That's so helpful. Well, y'all keep adding questions. Excuse me, weather changes. But just wanted to, piggyback too. I think you've shared so many good examples this morning about opportunities and ideas, but what kind of advice do you have for organizations that are thinking about working with CDFIs? They've thought about this, are there certain tools that they kind of need to have in place, or information that they should have ready as they're going to start these conversations? I think things that they should look for within those relationships as they're kind of evaluating what CDFI may be the best fit. What are sort of trips of the trade, just so they can kind of find those best fit partners?
Yeah, absolutely. And I'll say, as a different project, we're working on being able to provide connections to financing solutions through CDFIs and other ways as well, for workforce organizations to help finance opportunities. And I'm happy to share that resource as it becomes available. And one of the things that we're gathering from all of the CDFIs and the solution providers is exactly that of, for your product, what information is useful for an organization to bring. Because I think it can be different depending on what type of project you're working on. So hopefully that will be able to provide some really nuanced information depending on the project. I will say that I think that the partnership is twofold, and the advice that I would give is to use the CDFIs to their fullest extent for funding and also for partnerships. But conversely, don't be shy about what you have to offer as a workforce solutions organization. I didn't mention this in my presentation, but the project between Nonprofit Finance Fund and First Step was one of the first times that Nonprofit Finance Fund had worked with a workforce development organization. They had traditionally financed in other types of sectors. And First Step was able to educate nonprofit finance and then be able to expand their portfolio, so that, there's this pay it forward of First Step was able to give this information to Nonprofit Finance Fund, and then they were better equipped to serve other organizations in the future. So a big shout out to First Step. I think Amelia's here, for being able to provide that, because it increases opportunities for other organizations as well.
Yeah, absolutely. And thanks again. I know Amelia Nickerson is on the board of Max. And so if you've got questions too about how they did it, there you go. Certainly reach out to Amelia. And I love too, I think your presentation really showed a lot about the opportunities too, really thinking about the whole workforce perspective. You let kids have better access to, education funds, and then they're able to think more holistically about financial, well-being overall, better supporting their families, which I think is what, we all are striving for within workforce development, is creating that whole pipeline. So I think super excited and just grateful for y'all's work. Got another question about, are CDFIs only for nonprofits?
So no, the short answer is no, they're not. CDFIs can lend to any type of organization, or as I mentioned, they can also lend directly to consumers. So in many instances, CDFIs do operate in very similar manners to a bank, and you would be able to use their funds in that any sort of way that you would at a traditional bank, just with the added caveat that it could be lower cost because of their tolerance for higher risk, because they see that part of their return is through the impact that they have on their community.
Absolutely, which is fantastic. Thinking that holistically. Certainly too, I know Amelia shared her email in the chat if folks have questions about how to implement this. But Catherine, just wanted to make sure that anything else you want to share and kind of just give folks as they're considering this opportunity for their own organization, or maybe thinking about how they can leverage partnerships with other folks that are part of Max. Any closing thoughts just to send us off on a bang for Friday so we can start brainstorming and thinking creatively?
Yeah. I think that really, when you're thinking about projects that you have coming up, the sky's the limit. These partnerships were new, and they took a lot of work. So we're in an advantage here with Max that we already have so many relationships built. So you have the network of all of the members within Max to be able to reach through and understand the different ways that they've worked as well. So when you're thinking about products that already exist or programs that you're trying to start up, really reach for the stars and know that there are other organizations who are really excited by the same things. From community colleges to CDFIs to training facilities, to staffing organizations, and from housing to other sorts of community development as well. This is really a systems approach here.
And I think especially, I know everyone's trying to kind of rethink, reimagine, use your fun reword from coming out of the pandemic, and to think, just critically about how we use this opportunity to, reimagine, rethink, and have more effective systems. So I think this is great fuel for all of us to think through, and just appreciate, Catherine, y'all's research and everything that the Federal Reserve Bank of Atlanta does. And stay tuned, because Catherine's got more research about how you operationalize this. So again, a big thanks to Catherine too. And I know we've got Karen on too. So if you have any questions, feel free to, we're happy to connect you with the Atlanta Fed team. But again, thank you, Catherine.
Thank you so much for having me this morning. Very excited to share this with everyone.
Again, if you are not a member of Max yet, we certainly invite you to consider joining. Max Minutes is a program that we do for everyone. We think it's a huge value, and we really appreciate so many folks, engaging with us. But if you're not a member of Max, we certainly encourage you to do so. And this is a testimony from Geralda, kind of sharing why, they've been involved with Max before. And then from Shelley Miller as well, about why they are involved with Max. Certainly, we've got some information to one-pagers on the website. So if you need more information, feel free to contact us. Or Joy Wilkins always is willing to be so helpful, and she knows everything. So if you need questions or have specifics, we're happy to talk further. Just some things to note for future events. For Max members, we have a Max Talks on March 23rd. Our next Max Academy is on March 29th, all about trauma-informed care. And our next Max Minutes is on March 25th. And we're going to have the Bobby Dodd Institute talking about engaging people of all abilities in the workforce and some of what they're doing. So another great Max Anchor investor. I certainly really looking forward to our next conversation. And again, if you forgot who our anchor investors are, here they are. Thanks so much to First Step Staffing, BDI, Metro Atlanta Chamber, Goodwill of North Georgia, Atlanta Career Rise, WorkSource Georgia, and the state of Georgia. And with that, wish everyone a great Friday and a great weekend. We are so appreciative of you being with us, and looking forward to seeing you next time.